Asian markets ended on a weak footing today. Pressure was seen on major tech stocks, Tencent, while it's been a volatile week for the likes of energy prices. A much higher US CPI print of 7.9% is also likely to cause jitters around the interest rate trajectory. Over in Japan, the Nikkei share average declined by 2.05%. Hong Kong shares were also on a downer on the day, ending 1.61% in the red. But mainland China bucked the trend, with the Shanghai Composite Index posting a 0.4% increase on the day. Over in the United States, Wall Street resumed its sell-off on Thursday, closing lower as inflation hit a 40-year high, cementing expectations that the U.S. Federal Reserve would hike key interest rates next week to prevent the economy from overheating. The S&P 500 lost 0.44%, the Nasdaq Composite Index lost nearly 1%, and the Dow Jones Industrial Average fell 0.34%. Let's take a look at the indicators. Well, to unpack the markets for us, I'm joined by Tato Mashiro. He's a portfolio manager at Sanlam Private Wealth. Thank you very much, Tato, for joining us. As I mentioned in the introduction there, of course, US CPI coming in at 7.9%. We understand that's a 40-year high. And no doubt markets will be quite jitterish about that in terms of what it means in terms of the Fed's decision on interest rates. We know they're going to hike, but is it going to be a rapid increase?
Good afternoon, Nambu. The CPI print of 7.9% was, of course, the highest since 1982, and that does speak to inflation peaking significantly higher than the Fed would have forecast coming into the year, and perhaps even reaching double-digit marks at some point during the year. Of course, one should bear in mind that the February print was largely before the ramifications of the Ukraine conflict were well known. And so March, we would expect March to be significantly higher than the 7.9%. And as you said, it does have implications for the Fed's hiking trajectory. And the Fed Governor Jerome Powell has stated that they will be looking to do whatever it takes, as well as Madame Lagarde at the ECB, to bring inflation under control. Of course, one concern is that given the significant cost push nature of the inflation we're seeing, given supply chain shortages before the crisis, as well as new sanctions which put added pressure on supply chains, one wonders how successful monetary policy will be in terms of taming inflation in the current environment.
So despite the Russia-Ukraine conflict, of course, our local market has experienced wobbles like everybody else, but it does appear to have been a lot more resilient than global markets, and as well as our rand. I mean, our rand has strengthened to nearly 15 against the US dollar. We understand that's the commodity story, but how much longer can this go on?
Well, our market was relatively undervalued compared to other countries and other country indices, especially in the EM space and relative to DM as well. And this was prior to, obviously, the recent developments. And so, of course, with recent developments, we are likely to see commodity prices rise even higher. We did see benefits from that and from a macro and fiscal perspective last year. And I think another additional element is we're seeing rotation out of markets, especially Russia, and to some extent even China, and moving into other markets like South Africa and Brazil, for example, within the EM space. So I think there's quite a bit of rotation from EM fund managers. We obviously know the reasons around the Russia switch, but with China, of course, some people being somewhat concerned given the proximity to Russia, the lack of clarity with regards to how it may impact some of the surrounding markets, and of course the announcements from the SEC that we saw yesterday as well.
Yeah. We can't not talk about the oil price. It's something that's been on our minds for the past couple of weeks. It does seem to have come back quite nicely. It's below $110 a barrel currently. Is it too early to talk about a stabilization in the price? Because obviously, as South Africans, locally, we are concerned about what we're going to be having to pay at the pump, even though the rand is that much stronger.
Well, I think the mere fact that we are somewhat satisfied with an oil price around $110 per barrel speaks to the gravity of the situation. It's very rarely that oil prices have been north of $100 throughout history. And I think that we are going to see significantly higher prices for the short to medium term. Even if many of the major economies try to shift their procurement to other countries, that's still quite uncertain. So, of course, there's lots of talk around Iran and Venezuela and a few others, but there's limited production facilities, for example, in Iran for that oil to reach broader markets. And, of course, there's still significant demand from the East, from China and Japan, whether it's LNG or oil as well. So you're going to see a lot of, I suppose, bidding for any new production that does manage to come online, and that speaks to elevated prices going forward. As far as South Africa is concerned, I think petrol prices are likely to be higher for a significantly longer period of time, which speaks to importing inflation, and that's probably additional rate hikes from the Reserve Bank as well.
So with so many parts, of course, some of which we haven't covered in our very short interview, from an equity buying perspective, opportunity perspective, where do you see opportunities right now if people have some cash under their mattress?
Well, hopefully one would not be restricted to equities and could consider other asset classes. But if one were to focus purely on equities, it's quite clear that commodities, despite a very strong 2021, are likely to have a strong 2022 as well. There's just simply new factors which are leading to higher commodity prices, whereas previously it was purely a supply chain impact, whether it was semiconductors, automakers, and so on, which is quite beneficial for certain base metals and precious metals like our PGMs. Going forward, the Ukraine conflict, obviously you remove all of that oil and natural gas and potash from the market, as well as wheat. It speaks to elevated prices for longer. So commodities, definitely. One would have a look at financial services, in particular banks, given that the world is moving into a higher rate cycle, which is positive for net interest margins and endowment effects that will benefit the banking sector. I suppose within other sectors, you're going to have to, pick and choose to some extent. There's specific factors which should impact those other sectors differently. But I suppose most people would start off by looking at commodities and as well as banks and financial services.
Tato, thank you very much for your contribution this afternoon. That was Tato Mashego. He's a portfolio manager at Sanlam Private Wealth.